Briefing, the summary and key points from the Wall Street Journal, April 28, 2025. There are a total of 9 articles included in this briefing. Article 1, Social Security Claims Get Earlier. Fears over potential cuts and administrative chaos are pushing Americans to claim Social Security benefits earlier, despite long-term financial disadvantages. Article 2, The Magnificent Seven, Tech Stocks Suffer Bruising Losses. Big tech stocks have lost $2.5 trillion in value amid trade tensions, AI competition, and individual company struggles, dragging down broader markets. Article 3, China quietly exempts certain goods from retaliatory tariffs. China is discreetly waiving tariffs on critical U.S. goods like semiconductors to protect its own industries while maintaining pressure in the trade war. Article 4, Trump administration tightens control of federal workforce. The Trump administration is centralizing hiring and firing at the OPM, politicizing civil service performance evaluations, and reducing job protections. Article 5, Leather firms feel the pain of global trade tensions. Leather businesses are struggling with inventory backlogs and rising costs as trade war tariffs disrupt global supply chains without boosting U.S. production. Article 6, Longtime gold bull Paulson reaps a windfall. John Paulson's major gold investments are paying off amid a weakening dollar and global turmoil, and he's doubling down on gold mining projects. Article 7, An Investor's Guide to Gold. Gold is rising as a hedge against inflation and uncertainty, with investment options ranging from physical gold to ETFs and mining stocks. Article 8, Huawei challenges NVIDIA in AI. Huawei is testing a new AI chip to compete with NVIDIA's top models, advancing despite U.S. export restrictions and production challenges. Article 9, Russia's Crimea land grab, a trial run for Ukraine invasion. Russia's annexation of Crimea in 2014 emboldened its broader invasion of Ukraine, with Trump now signaling support for Russia's claim. Article 10, Companies cut costs amid tariff uncertainty. Uncertain trade policies are driving companies to cut spending, slow hiring, and delay investments while trying to avoid major layoffs. Social Security claims get earlier. Americans anxious about the future of Social Security are claiming their benefits earlier than planned, even though it can mean less income over the rest of their lives. The Social Security Administration has been shedding staff and changing requirements for claiming benefits over the phone. President Trump has been pushing to cut spending, though he has vowed not to reduce benefits. Pending Social Security claims for retirement, survivor, and health insurance benefits totaled 580,887 in March, up from 527 a year earlier. While multiple factors likely contributed to the increase, agency officials said at a March 28 meeting that fear-mongering has driven people to claim benefits earlier. Many effects of the Trump administration's swift and sweeping changes to federal agencies aren't yet apparent, but the ones being made to Social Security are already changing households' financial decisions. Americans have long been anxious about Social Security's stability, and Trump's actions are heightening those anxieties. That is leading people to make decisions based on fear, said Kathleen Romig, Director of Social Security and Disability Policy at the Center on Budget and Policy Priorities. Christine Banner, 65, originally intended to file for her Social Security in about 2 years. She and her husband, Clint Banner, who already receives his benefit, recently decided to file for hers this year. Trump and his advisors have made claims of widespread fraud in the program, and the Cary, North Carolina couple worry the allegations could be used to justify benefit cuts or service disruptions. The Social Security Agency has estimated that improper payments represented 0.3% of total benefits. Christine opted to take her monthly check of $1,633, even though it is about $130 less than she would receive at her full retirement age of nearly 67. That currently amounts to a reduction of more than $1,500 a year. The couple hopes that if they are already receiving benefits, they won't face any future reductions. Economists and financial advisors generally discourage claiming early. Benefits increase with each month someone waits to take them beyond the minimum claiming age of 62. The increases stop at age 70. Benefits starting at 70 are 76% higher than at 62, according to Lawrence Kotlikoff, a Boston University economist and founder of Maximize My Social Security. A person who postpones benefits until 70 instead of 62 would come out ahead if they lived to at least 80, he said. Liz Houston, a White House spokeswoman, cited other causes for the increase in claims in March, including aging baby boomers claiming benefits and a new law that raises benefits for some government retirees. She said, "There is no confusion. President Trump has been extremely clear. He promised to protect and strengthen Social Security. Calls to the agency since the beginning of October are up 19% compared with the same period a year earlier, officials said at the meeting. Website traffic and field office calls are higher as well, they said. I think we have a lot of customers that right now, a lot of Americans that are very uneasy, said Leland Dudek, acting Social Security Commissioner at the meeting. Another official said that one woman recently came to a field office to show her ID because she was afraid she was going to lose access to her benefits. Recent surveys reflect the concern. More than 75% of U.S. adults worry a great deal or a fair amount about Social Security, a 13-year high, according to a March Gallup poll. Democrats expressed greater concern than Republicans. When Social Security's finances are referenced negatively in the news, workers tend to report a desire to claim benefits earlier, according to a 2021 study by the Center for Retirement Research at Boston College. Social Security's finances have long been under pressure because of the aging of the population. Unless Congress shores up the retirement program, it is projected to deplete its reserves in 2033, which would trigger a 21% reduction in benefits. Isabel Barrow, Director of Financial Planning at Edelman Financial Engines, said she has received an uptick in questions lately from people concerned about Social Security cuts, even among people already receiving benefits. Some asked about the safety of personal data. Social Security officials said at the meeting that many Americans are visiting field offices for help accessing their accounts on the agency's website. Some are paying the agency $100 for certified copies of their earnings records, on which benefits are based. Dan Heatpus, 64, said he had planned to delay claiming until nearly age 67, when he is eligible for his full benefit. But the Chippewa Falls, Wisconsin resident, who retired from teaching 5 years ago, filed in January due to concerns about benefit cuts and chaos at the agency. His wife, Jill Heatpus, 66, began her Social Security last year. The couple printed out their earnings records in case their data disappears or becomes inaccurate. A Social Security official said at the meeting that personal data is secure and the agency has backups. He acknowledged 2 website outages in March that he said were brief. Retirees also take Social Security sooner than expected for reasons including deteriorating health and job losses. About a quarter of people filed for benefits when they turned the minimum claiming age of 62 in 2023, the most recent data available. Ina Rivelis, an advisor in Windham, New Hampshire, said a few of her clients retiring this year are claiming Social Security sooner than planned. In addition to concerns about changes at the agency, they are worried about withdrawing from their portfolios while the markets are down. Rivelis has told them to set aside 3 extra months of cash in case of delays processing claims. The agency said 82% of benefits were processed on time in March. The Magnificent Seven, tech stocks suffer bruising losses. The 7 tech stocks that drove the stock market's bull run are now suffering significant losses. Each company's stock has fallen more than 6.5% this year, shedding a collective $2.5 trillion in market value. For the past 2 years, this group of mega-sized tech companies, Alphabet, Amazon.com, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla, fueled a strong rally that lifted stocks out of the 2022 bear market. Investors propelled their shares to high levels, praising their strong balance sheets and leadership in the artificial intelligence race. Now, even after a recent rally, the Magnificent Seven are experiencing their worst start to a year since the 2022 downturn, according to Dow Jones market data. Each stock has fallen more than 6.5%, and they have collectively lost $2.5 trillion in market value. The Roundhill Magnificent 7 exchange-traded fund, despite its best 4-day run ever, a 13% climb, remains down about 15% this year. This downturn follows the emergence of DeepSeek's AI model in January, which dented confidence in U.S. tech companies' AI leadership. President Trump's global trade war also threatened the American exceptionalism trade, based on strong U.S. growth and technological advancements. Additionally, some companies face individual challenges impacting their shares. From magnificent to maleficent, it's just become a massive challenge, said Matt Orton, head of market strategy at Raymond James Investment Management, referencing the villain in Sleeping Beauty. Some of the shine has been lost with respect to the story. It was only a matter of time. Investors will assess the Magnificent Seven's prospects when Meta, Microsoft, Apple, and Amazon report earnings in the coming days. Nvidia's results are due in late May. Traders worried during the AI-fueled rally that the U.S. market was overly reliant on a few companies. Many warned that their boost could quickly turn into a major drag. The group represented about 36% of the S&P 500's market value at its peak in December, according to Dow Jones market data. The S&P 500's total return, including dividends, is down 5.7% this year. Without the Magnificent Seven, returns would be down just 1.2%, according to S&P Dow Jones Indices data. The tech-heavy Nasdaq Composite Index is in a bear market, down 20% from its recent high and 10% year-to-date. Some investors are concerned that the Magnificent Seven slump will hinder major indexes' recovery. When the generals fall, people tend to get nervous, said Katie Stockton, founder and managing partner of Fairlead Strategies. The group's earnings dominance is expected to decrease. Analysts polled by FactSet project a 16% profit increase for the Magnificent Seven in 2025, down from about 37% in 2024. They project a 7.8% earnings jump for other S&P 500 companies, up from about 5% last year. Recent turbulence has highlighted each company's unique problems. Tesla reported a 71% drop in first-quarter net income following a slump in automotive sales. Nvidia warned of a $5.5 billion charge due to new China export curbs. Apple is grappling with weak iPhone sales and delays in its AI Siri enhancements. Alphabet forecast pressure on Google's advertising business from changes to the de minimis rule on tariffs. Some analysts believe the Magnificent Seven's valuations are still high. Nvidia trades at 23 times its projected earnings over the next 12 months, down from 31 at the beginning of the year, Meta at 21, down from 23 in January, and the S&P 500 at 20. These concerns echo those from when the group was known as FAANG, Facebook, Amazon, Apple, Netflix, and Google. Tech shares plunged in 2022 after the Federal Reserve raised interest rates, as investors feared higher borrowing costs would hamper profits. These stocks rebounded in 2023, but the FAANG era ended when Bank of America's Michael Hartnett coined the term Magnificent Seven. Hartnett, who named the group after a 1960 film, later called them Lagnificent in a January note. However, he expects the group's competitive advantages and U.S. financial primacy will eventually attract investors. At the end of the day, nobody wants to own bonds, Hartnett said. There's only so much gold in European equities or emerging markets. And so it's almost by default you go back to the U.S. equity market. China quietly exempts certain goods from retaliatory tariffs. China's government has exempted some U.S. imports from its retaliatory tariffs, specifically those the country would struggle to immediately source elsewhere, according to people familiar with the matter. Chinese authorities have informed some importers that they will waive the recent 125% tariff increases on certain U.S. imports. These products include semiconductors and chip-making equipment, medical products, and aviation parts. These exemptions highlight vulnerabilities in China's economy. Many Chinese industries, particularly in advanced technology, aerospace, and pharmaceuticals, rely on American-made inputs. The Trump administration similarly announced exemptions on its reciprocal tariffs for Chinese-made smartphones, laptops, and other electronics earlier this month, acknowledging U.S. reliance on China for these goods. When Trump imposed a cumulative 20% levy on all Chinese imports, Beijing responded with targeted tariffs on some U.S. imports, including energy products and vehicles. It didn't implement across-the-board tariffs until Trump's Liberation Day tariffs on April 2, which added 34% to all Chinese goods. Beijing subsequently matched Trump's tariff increases, resulting in the current 125% tariff on all U.S. goods. Two semiconductor traders stated that Chinese customs lifted tariffs on 8 categories of U.S.-made chips, including central processing units, starting April 24. However, tariffs on U.S. memory chips remain. Many chip products from Intel and Texas Instruments are exempt, while some Micron Technology products remain subject to duties. Beijing has prepared a list of U.S. imports for tariff removal, including some industrial chemicals, quartz and ethane, lithography machines, helicopters, and vaccines. However, this list may change. During the tariff war, Chinese officials surveyed companies and industry groups to determine which U.S. goods should be exempted to protect China's interests. Beijing has avoided publicly announcing these exemptions to avoid revealing structural vulnerabilities and to allow for future adjustments and negotiations. This effort involved several government bodies, coordinated by the Customs Tariff Commission of the State Council. They want to make sure the Chinese tariffs don't harm their economy, said Michael Hart, president of the American Chamber of Commerce in China. Hart said Beijing had been asking U.S. firms what American components they import that are unobtainable elsewhere. Hart noted that pharmaceutical companies anecdotally reported exemptions for some shipments to China. China's aviation regulator has instructed airlines to halt receiving aircraft and components from the U.S. The exemption on aircraft parts, such as engines, allows for continued aircraft maintenance and manufacturing. Trump administration tightens control of federal workforce. The Trump administration is consolidating control over federal worker hiring and firing, centralizing power within the Office of Personnel Management, OPM. This effort mirrors some of Elon Musk's previous proposals for shrinking the U.S. government. OPM, a key agency in this initiative, has begun approving positions federal agencies want to add, a shift from the previous system where agencies made these decisions. Following the inauguration, OPM's upper ranks were filled with personnel connected to Musk's Department of Government Efficiency. They issued orders weakening other agencies' control over their workforces, bringing hiring, firing, and performance evaluations under OPM's purview. For some employees, performance will be based primarily on advancing the president's agenda. Top-ranking bureaucrats will be evaluated on their faithful administration of the law and the president's policies, according to memos from OPM Acting Director Chuck Ezell. Agencies were directed to adopt this performance plan by the beginning of fiscal year 2026. This contrasts with previous evaluations based on competencies like business acumen and leadership skills. Musk has since stated he will withdraw from leading the government-slashing campaign. However, OPM is expected to continue institutionalizing this mandate, according to current and former OPM employees. An OPM official stated the agency is reviewing new agency positions to ensure they are exempt from a government-wide hiring freeze, which will end once the freeze is lifted. The freeze has been extended to mid-July. OPM has long been a focus of right-of-center groups, including Project 2025, which argued that the federal workforce is burdened by hard-to-fire, poor-performing employees. Several employees from conservative groups advocating for reduced federal employment have joined OPM. The agency is proposing regulations to determine which executive branch employees should be fired, as outlined in a March 20 presidential memorandum. OPM would have the authority to fire employees not meeting its suitability criteria. Agencies would refer employees to OPM for review. This would give OPM greater oversight of current employees, expediting the firing of those who committed crimes or engaged in violent or dishonest conduct. Most government employees are mid- and low-level civil servants protected from political hiring decisions. The Trump administration aims to change this, with ousting federal workers a primary goal following the inauguration. These efforts have resulted in tens of thousands of layoffs. Centralizing hiring and firing decisions at OPM is viewed by some as a power grab that will politicize the process. Dylan Hetler-Gaudet, Director of Government Affairs at the Project on Government Oversight, stated that the merit-based system aims to depoliticize the federal government. OPM has ordered agencies to reduce positions reserved for executive-level career civil servants, who have stronger termination protections. This could facilitate placing presidential appointees and firing personnel in key bureaucratic roles. Federal workers involved in diversity, equity, and inclusion programs were among OPM's initial targets, along with thousands of probationary workers. The Supreme Court ruled that the administration's firing of approximately 16,000 workers could proceed. Vice President J.D. Vance foreshadowed these moves in a 2021 interview, suggesting that Trump should fire every single mid-level bureaucrat, every civil servant, in the administrative state. Replace them with our people. Leather firms feel the pain of global trade tensions. Hundreds of thousands of salt-cured cattle hides are accumulating in Aaron Tasman's warehouses, creating a time-sensitive problem. Tasman's leather business includes tanneries in Mexico, a Kentucky storefront, a leather sales business, and hide processing facilities across the U.S. He usually sells hides to manufacturers in China but halted shipments last month due to concerns about buyers' willingness to pay increased prices during the trade war. He continues paying for hides weekly, unsure how long he can sustain this. "I've got employees and they're my friends," Tasman said. "We feel like a real family. I've got to get them some hours." The international leather goods supply chain is complex, often involving factories on multiple continents. The current tariff situation forces businesses to either adapt or face financial risks. Twisted X, a boot seller, has established a tariff war room to find a new manufacturing location. They previously relied on China for production, but have stopped importing goods from there. They are now searching for factories in Cambodia, Bangladesh, Vietnam, and India, relying on existing inventory in the meantime. "We walk in every day with new questions," Jones said. "It's very chaotic right now." The U.S. trade imbalance for leather and allied products is significant, with imports exceeding exports by a factor of more than 10 last year, according to the Census Bureau. China accounted for nearly one-third of imports. Businesses most affected are those shipping hides across the Pacific or receiving finished goods from China. The U.S. was once a major leather manufacturing center. The golden age of leather tanning in the U.S. is behind us, said Marshall Baird, senior vice president at Weaver Leather. It's not the easiest business to get into. It's as much art as it's science. It's a dirty, messy process. While the Trump administration suggested that import duties would boost domestic manufacturing, the hardest-hit businesses are those purchasing finished leather goods from China, not those buying leather from tanneries. These businesses are shifting to other foreign producers to reduce costs, not to American factories. Greg Cooper's Texas leather trim usually trucks tanned hides to a warehouse. When Trump's 25% tariffs on Mexican imports were about to take effect, Cooper had $100,000 worth of leather en route from a Mexican tannery. He stalled the truck near the border until the tariffs were lifted. He now monitors trade developments and adds tariff charges to invoices, fielding calls from worried industry peers. The footwear manufacturers that still produce there are struggling. It's a mass exodus, he said, everyone's looking for the next country. Saddleback Leather Company has a global supply chain, hides from Scandinavia, tanning in Italy, manufacturing in Mexico, and sales in the U.S. Dave Munson, the owner, plans to ship goods directly from the Mexican factory to international buyers, bypassing the U.S. Smaller businesses selling footwear, chains, purses, and cowhide rugs reported increased store traffic as consumers rushed to buy before price increases. Many plan to absorb tariff costs to maintain prices. Alcala's Western Wear is using its inventory to buy time. Even with potential long-term tariffs on Mexican imports, they won't shift production. We are from Mexico and we will always support them, said Monty Alcala, marketing manager. The products that come from Mexico are dear to us. We will never get rid of them. Businesses hope their inventories last until trade tensions ease. Alcala noted increased interest in Western goods as a positive factor. Matt Bressler, vice president at Wicket Craig, a Pennsylvania tannery, believes tariffs on imported leather could benefit his company. However, he is concerned about consumer demand for leather goods during an economic downturn. People are only going to buy luxury leather goods when they're feeling good about things, he said. That's just the way it is. Longtime gold bull Paulson reaps a windfall. John Paulson, who famously profited from betting against the U.S. housing market, is now reaping significant rewards from a long-term gold investment. More than a decade and a half after making a substantial gold investment, Paulson is benefiting from the precious metals record surge. President Trump's trade war and threats regarding the Federal Reserve Chairman weakened the dollar and propelled gold prices above $3,500 per troy ounce. Gold's rise contrasted with the decline in stocks and bonds. Instead of selling, Paulson is increasing his investment, contributing $800 million to acquire a significant stake in a remote Alaskan gold mine. There's only one reserve in physical form that will protect you against all these things for literally millennia, said Paulson, citing inflation and government asset confiscation as potential risks. Gold has been a valuable asset for centuries, serving as a monetary system foundation. Although President Nixon unpegged the dollar from gold in 1971, substantial gold reserves remain at Fort Knox and in central banks globally. Gold is considered a hedge against inflation, war, catastrophe, and currency devaluation. While these crises aren't currently prevalent in the U.S., global geopolitical tensions, a weakening dollar, and expectations of continued central bank gold purchases have strengthened Paulson's conviction. Gold investment isn't always profitable, it incurs storage costs and doesn't pay interest. There have been periods where stocks and bonds outperformed gold. Paulson's belief in gold emerged during his success betting against the U.S. housing market. His hedge fund earned $15 billion in 2007, with Paulson receiving nearly $4 billion. Concerned about inflation from the Fed's quantitative easing in response to the 2008 to 2009 financial crisis, he invested in gold at around $900 per troy ounce. His early investments were successful, and he even offered gold-denominated versions of his hedge fund strategies. However, his inflation prediction didn't materialize, impacting some of his wagers, including investments in mining stocks, pharmaceutical companies, and bank stocks. He converted his hedge fund into a private investment manager in 2020, managing money for himself, employees, and related entities. Since then, he's been involved in a legal dispute, hosted a Trump fundraiser, and was briefly considered for Treasury Secretary. Gold's value increased due to COVID-era stimulus, inflation, war, and sanctions. Paulson doesn't disclose his total gold holdings but invests mainly through mining companies, using derivatives for some exposure. He doesn't own physical gold. His listed mining company investments are valued at approximately $840 million, according to Marcelo Kim, a partner at Paulson's firm. All 8 mining stocks he reported holding as of December have increased in value this year, many by more than 30%. Paulson believes mining companies' profits increase significantly with rising gold prices while mining costs remain relatively fixed, providing profit potential even if gold prices decline. He primarily invests in emerging mining companies, including Perpetua Resources, Agnico Eagle Mines, and International Tower Hill Mines. We really shifted our focus to mine development because that's where you can get your biggest bang for the buck, Paulson said. You don't need the gold price to go up to receive high returns. Kim has visited approximately 150 mines globally, including the Alaskan gold deposit Paulson invested in. Paulson partnered with Thomas Kaplan to purchase Barrick Gold's 50% stake in the Donlin project for $1 billion, acquiring a 40% stake with his $800 million contribution. Paulson anticipates significant returns from Donlin, an undeveloped high-grade deposit containing an estimated 39 million ounces of gold. Development is substantial. A 2021 report estimated capital costs of $7.4 billion, plus $1.7 billion over the mine's lifespan. Infrastructure development, including a road and pipeline, may be necessary. The mine is unlikely to begin production before the early 2030s. This is going to be a monster asset that's going to last for 50 years plus, Paulson said. An investor's guide to gold. Gold is an alternative investment to stocks and bonds, often serving as a safe haven during market volatility or economic uncertainty. Several investment methods exist, from futures contracts to exchange-traded funds, ETFs. Many on Wall Street recommend including a small gold allocation in a portfolio. Why are gold prices soaring? Gold's recent surge is attributed to President Trump's tariffs causing Wall Street turmoil and predictions of rising inflation and a weaker dollar, all of which increase gold's appeal. Geopolitical tensions such as the US-China trade war, the Russia-Ukraine conflict, and the Israel-Hamas war also contribute to gold's rise. What does it mean to invest in gold? Owning gold typically involves holding physical gold bars or coins, gold ETFs, gold futures, or shares of gold mining companies. The World Gold Council estimates over 215,000 metric tons of above-ground gold, valued at over $20 trillion. Why should I invest in gold? Gold can cushion portfolios from volatility and economic uncertainty. However, gold prices can be volatile despite its reputation as a safe haven. Gold prices tend to rise during economic concerns or geopolitical shocks, offsetting potential stock declines. Gold also hedges against inflation. Higher consumer prices increase the dollar cost of gold, boosting its price. Inflation weakens the dollar, making dollar-denominated assets like gold more attractive to international buyers. Gold can be used to bet on falling interest rates. Lower rates make gold more appealing by reducing government bond returns, giving gold an advantage as a haven asset that doesn't offer regular payouts. Investors tracking gold often monitor inflation-adjusted interest rates to gauge price movements. Physical gold. Standardized physical gold bars and coins, bullion, can be purchased from dealers worldwide, such as APMEX and JM Bullion, often online. Dealers verify authenticity and frequently work with mints like the U.S. Mint, Royal Canadian Mint, and Perth Mint, which also sell gold products directly. Gold funds. Gold ETFs are a popular way to invest in gold without holding physical gold. They are easily purchased through brokerage accounts. Shares of ETFs like SPDR Gold Shares, the largest gold fund, represent a stake in a trust holding gold bars, making the ETF price generally track the gold price. Annual fees apply. While most large gold ETFs hold physical gold, some invest in gold futures or use a combination of debt and derivatives to track gold's price. Gold futures. Gold futures contracts obligate buyers to buy or sell gold at a specific price on a specific date. They are used for price speculation. Gold miners use them to hedge against price declines. Upon expiration, holders typically take ownership of physical gold. Many traders avoid this by selling contracts before expiration and buying future contracts, rolling. Some futures or cash-settled options are similar, but grant the holder the choice, not the obligation, to buy or sell gold at a specific price and date. Futures and options are traded through brokerage platforms such as Charles Schwab and Fidelity. Gold mining stocks. Shares of gold miners like Newmont and Barrick Gold can be purchased through brokerages. Their prices tend to correlate with gold prices but historically show greater volatility. They rise more quickly when gold rises and fall faster when gold falls. ETFs and mutual funds investing in gold miners also exist. Why might gold not be a good bet? Gold can be volatile when it becomes a crowded trade. Investors don't earn interest on gold, making it less attractive when interest rates are expected to rise or remain steady. Finally, gold tends to underperform when geopolitical tensions and economic uncertainty decrease. Huawei challenges NVIDIA in AI. Huawei Technologies is preparing to test its new high-performance artificial intelligence (AI) processor, the Ascend 910D, aiming to replace some of NVIDIA's higher-end products. This advancement highlights the resilience of China's semiconductor industry despite U.S. efforts to hinder it, including restricting access to Western chip-making equipment. Huawei has approached Chinese tech companies to test the Ascend 910D's feasibility. The company expects to receive initial samples as early as late May. The development is in its early stages, requiring performance testing before customer release. Huawei aims for the Ascend 910D to surpass NVIDIA's H100, a popular AI training chip released in 2022. Previous versions are the 910B and 910C. Huawei has become a leader in China's AI sector, where the U.S. maintains a technological advantage. The Shenzhen-based company has developed promising substitutes for NVIDIA's AI chips, contributing to Beijing's goal of a self-sufficient semiconductor industry. Huawei, on a U.S. trade blacklist for nearly 6 years, demonstrated its ability to circumvent American restrictions by releasing the Mate 60 smartphone in 2023. Powered by a locally produced processor, its release during Commerce Secretary Gina Raimondo's visit to Beijing raised concerns within the U.S. government. This month, the U.S. added NVIDIA's H20 chip, its most advanced chip saleable in China without a license, to its restricted semiconductor list. NVIDIA reported a $5.5 billion charge as a result. These restrictions create opportunities for Chinese rivals like Huawei and Cambricon Technologies. Huawei plans to ship over 800,000 Ascend 910B and 910C chips this year to customers including state-owned telecommunications carriers and private AI developers like ByteDance, TikTok's parent company. Some buyers are discussing increased 910C orders following U.S. restrictions on NVIDIA's H20. Despite manufacturing constraints, Huawei and other Chinese chip companies have delivered products comparable to NVIDIA chips, albeit with a delay of several years. They utilize technologies combining multiple chips to create more powerful processors, as miniaturizing circuitry becomes increasingly difficult and expensive. Beijing has encouraged Chinese AI developers to increase domestic chip purchases, with state data centers reporting using mostly Chinese-supplied chips. However, previous Huawei chips have faced challenges. The 910C, marketed as comparable to NVIDIA's H100, underperformed in real-world tests, according to engineers. Huawei also faces production scaling challenges, having been cut off from Taiwan Semiconductor Manufacturing, the world's largest chip foundry. Semiconductor Manufacturing International, China's closest alternative, faces restrictions on purchasing advanced chip-making equipment. Russia's Crimea land grab, a trial run for Ukraine invasion. A key point of contention in President Trump's attempts to end the war in Ukraine is Crimea, a Black Sea peninsula central to Vladimir Putin's agenda. For over a decade, U.S. administrations, including Trump's first, condemned Russia's 2014 annexation of Crimea, stating they wouldn't recognize it but offering little support to Ukraine for its recovery. Trump now publicly supports Crimea becoming part of Russia, a position rejected by Ukrainian President Volodymyr Zelensky. Trump and Zelensky met briefly before Pope Francis's funeral, their first face-to-face meeting since a February encounter. Both described the meeting positively, but Trump later criticized Putin on social media, questioning his desire to end the war. Since seizing Crimea, Russia has suppressed opposition and promoted a Russian historical narrative through museums, schools, and repression. Ukraine and its allies view the annexation as a violation of international law, believing the West's weak response emboldened Russia. Initially, Russia denied troop presence. Following the 2014 ouster of a pro-Russian Ukrainian president, unmarked soldiers appeared near the Sevastopol naval base. Despite Ukrainian protests, special forces seized the Crimean parliament on February 27, raising a Russian flag and overseeing a referendum on joining Russia. The Kiev government, struggling to form a new administration and discouraged from fighting by Washington, didn't order resistance. The Obama administration responded with expressions of displeasure, calls for de-escalation, and sanctions against some Russian officials. Crimea was transferred to Ukraine in 1954 by Nikita Khrushchev, citing economic and cultural ties. Over half of Crimean voters favored Ukrainian independence in the 1991 referendum. Russia presented its 2014 referendum as a homecoming, contrasting Russian peace with Ukrainian Nazism. Ukrainian media was blocked. Pro-Ukrainian demonstrations initially continued, culminating in a March 9 protest. Then disappearances began, including activists from the Crimean Tatar community. Rezhat Amitov, an activist, was found dead before the referendum. On March 16, the referendum was held at gunpoint, with Russia declaring 95.5% support. Putin signed a law integrating Crimea the following day. Crimea was the base from which everything began, said Ol Skrypnyk, who left Crimea on referendum day. That's why the takeover of Crimea was only the first step toward the full-scale invasion. Russia was not going to stop. Russia swiftly erased Ukrainian presence, increasing military presence and population influx. A new court system was established, targeting those deemed threats by Russian authorities. The Kerch Strait Bridge, connecting Crimea to Russia, became a symbol of the annexation. Before the 2022 invasion, Russia used Crimea as a staging ground for occupying Zaporizhia and Kherson regions. It served as a logistics hub, subject to Ukrainian missile and drone attacks, including 2 strikes on the Kerch Bridge. Sevastopol port was used to export stolen grain, and Crimean prisons held detained Ukrainians. Crimean camps housed children taken from Ukraine. Russia intensified its crackdown on pro-Ukrainian sentiment, seizing twice as many properties since 2022 compared to the previous 8 years. Women and the elderly are increasingly targeted. Zelensky emphasized Ukraine's refusal to cede Crimea, citing a 2018 statement by Mike Pompeo stating that no country can change another's borders by force. Trump, however, remained ambiguous about Crimea's future. Companies cut costs amid tariff uncertainty. The unpredictability of President Trump's trade policies is forcing companies to prioritize cost-cutting measures. Dow Chemical is delaying a new plant's construction, Boston Scientific is reducing discretionary spending, including travel, and Norfolk Southern is scrutinizing consultant fees. Andre Schulten, Procter & Gamble's CFO, stated, "We will have to pull every lever we have in our arsenal to mitigate the impact of tariffs within our cost structure." While large-scale layoffs are uncommon, companies are slowing hiring, leaving positions unfilled, and reducing spending on consultants and contractors. CEOs during recent earnings calls described cost-cutting measures using language similar to the Serenity Prayer. Norfolk Southern CEO Mark George stated, "Control the controllables and try to help mitigate some of the things we can't control." Citing plans to reduce fuel and labor costs, Norfolk Southern cited financial pressures to improve efficiency following recent disruptions, including the East Palestine train derailment, an activist-investor proxy battle, and an unplanned leadership change. IBM CEO Arvind Krishna focused on controllable areas, including productivity initiatives. PepsiCo CEO Ramon Laguarta emphasized supply chain efficiency. Other executives mentioned reviewing various cost-cutting options. The unpredictable nature of tariff policies limits companies' ability to plan investments or adjust supply chains. However, cost-cutting remains a viable strategy during uncertainty. Some companies are accelerating existing efforts. Hasbro will expedite its multi-year cost-cutting plan, aiming for $175 million to $225 million in savings this year. Past cost savings involved design changes to reduce production costs. Dow plans to cut approximately $6 billion in costs following a first-quarter loss, focusing on capital expenditures. They will delay an ethylene plant's construction and reconsider plans for chemical plants in Germany and the UK. Principal Financial Group's interim CFO, Joel Pitts, stated the company will closely monitor expenses, including consultant spending and employee travel, and delay hiring. Executives and corporate advisors believe internal cost-cutting and streamlining allow companies to act proactively despite uncertainty. Ron Williams, a former Aetna CEO, noted, "It's a good opportunity to say, are we as efficient and effective as we could be?" Many companies are avoiding drastic cuts that could hinder operations if trade tensions ease or the economy improves. Williams explained, "A lot of companies are not looking at layoffs per se because they lived through COVID and lost a lot of talent that was difficult to replace. Companies are deferring expenditures until greater clarity emerges." GE Aerospace CEO Larry Culp aims to avoid cuts to research and development or supply chain disruptions. Instead, they are reviewing areas like corporate travel, back-office expenses, and hiring. GE Aerospace estimates tariffs will cost $500 million this year. Culp noted, there's always more opportunity for cost reduction. Some companies are implementing job cuts. Robert Half eliminated unspecified administrative and corporate positions, saving $80 million. CEO Keith Waddell stated that post-election business confidence increased, but that has since changed.